I'm going to talk with Stefan from Alts about what might be characterized as esoteric alternative investments. So welcome, Stefan.
Great to be here. Thank you.
So you're the founder of a company that wants to be our alternative investment Sherpa. And there's a lot of different assets out there. So perhaps we can start with that. Give us an overview of how you came up with the idea and what we can find there, from vinyl records to sports to website, etc. It's a very exciting place.
Yeah, absolutely. So a little bit about our background. This whole business was a COVID baby. I live here in Melbourne, Australia, and back in 2020, when the rest of the world was going through some small lockdowns, here in Melbourne, we had a 3.5, 4 month mega lockdown. So I had nothing better to do all day except do what I love doing, which is writing. And I was writing about alternative investing through the lens of really through micro private equity. So at the time, I was working for a company called Flippa.com, which is buying and selling SMBs, digital businesses under $2 million. These are like small kind of PE deals. But I really love that world and started writing about it on Substack, actually, which is funny because later we got off Substack and now I'm re-exploring it a bit. But that's where this whole thing started, was actually on Substack. And so I started the newsletter back in 2020, and it just started growing and growing, and thousands of subscribers. And around maybe like 10,000 subscribers, I noticed there was another gentleman who had his own Substack, and he was writing about alternative investing as well. His name was Wyatt. I'd never met him in person, but we chatted a lot through Substack and through Twitter and what have you. And we were competing against each other a little bit. So basically, I just called him up one day and I was like, hey, man, I don't really want to compete with you anymore. Like, we're doing the same thing. Like, why don't we just do it together? Let's join forces. I know we've never met. What do you say? And he's like, well, it sounds interesting. Like, what's your real vision, though? And I said, well, at the time, I told him, I said, I want to start a fund or a series of funds and eventually an ETF, and think of it like Yieldstreet for esoteric alternatives, right? And that vision has changed over the years, but that was something that he was thinking along the lines of as well. And so we had a couple of Zoom calls and we decided to form the company. And so that's pretty much the history. And then so now fast forward to today, which is coming up on about 5 years later, and we are just at a whole different world now. So we we're not just, you mentioned Sherpa earlier. That's how
Took
we
it from the
started.
website. I took it from the
Yeah.
website.
That website's about to get revamped, and that word is going to go. The reason that the word's going to go, though, is because we don't. We used to be. That's how we started. Is like that Sherpa mentality, right? Like we would explore these different esoteric asset classes, really go hard into the due diligence side of things, and really like not mess around with the analysis, right? Like you and I both know. We've talked about this a lot. There's a lot of crap out there. There's a lot of finfluencers. There's a lot of fake analysis and people who don't really put in the hard work to understand eclectic markets. And that is definitely not us. We care a lot. Both Wyatt, my co-founder, and I come from a due diligence background. That's what I was doing when I was at Flippa. And Wyatt, one of the things I first loved about him when I met him was he came up with this algorithm, like this equation for valuing rare books, which was like unlike anything I'd ever seen before. And so we both love due diligence. And so for a long time, that was kind of our MO. Like we would diligence these deals, but we didn't really allow for people to invest in them. We didn't have any sort of rails or infrastructure or platform or anything like that. That all changed about 2 years ago when we created our private community for accredited investors, which we call Altea. And so with Altea, we're doing a couple things. Number one, we're bringing those interesting deals for accredited investors. Number two, we're diligencing them, vetting them, and evaluating them alongside the community, which is something I know we'll talk about in a bit. And number three, we're opening up vehicles. We're opening up SPVs for the very best of the best that we bring to the community. So we do about 12 SPVs per year, and we've got about 13, 14 million under management across those SPVs. These are in artwork, tequila barrels. We do some Ferrari arbitrage. We do a lot of film financing, debt financing, right? So gap financing. We don't do film equity. We are about to close our first K-pop music rights deal. And yeah, if it's not mainstream, we love it. So that's basically us in a nutshell.
So yeah, no, thank you. I was going to ask about an overview of the kind of investments that we can access there, but I think we've got a good idea with the list that you just said. And so we understand now the business and also how it started. And I was an early subscriber because I also started, I think, my personal, let's say, exploration, investigation to this world about the same time. I think I'm going to jump right into it. This other dimension of investing, because obviously, when I see what you're saying, I think, oh, this is interesting stuff, right? But I also, on the other hand, have, well, let's say, my conservative brain thinks like, okay, well, maybe it's not for me, but in any case, this sounds like just the size of it. If you call it about micro equity, to me, is something that, or then it can be very interesting to get involved, hands-on into a company, but whatever. I don't even buy small stocks on the stock market because I think it's too risky. But obviously, you've got to, I'm sure you deliver, the goal is to deliver healthy profits, and that's the due diligence, etc. But is there another dimension to it? And I think there is, such as those are great deals. Do people really thoroughly analyze them because they, out of all the whole universe, they think, oh, this is the most return on investment? Or is there something that's more prevalent, which is like it's interesting, it's fun, you learn something. How do you think people approach that? And also, how do you take into account that? So there's obviously a tension here between return on investment and return on something else.
We really, we try to find the sweet spot of it's interesting and you're the most interesting person at the party and all of that. And it is a good deal. That part is never not important. We've had a lot of deals, a lot of interesting deals that we haven't pursued or filled, or they fell apart during due diligence. Cool stuff, sexy stuff, unsexy stuff, it doesn't matter. If it doesn't, the numbers don't work, the numbers don't work, like, period. And that's funny because there is a lot of, you're right, like like an element of what we do, and this is like the royal we I'm talking, like alternative investing, is that a lot of it is pretty, there's a motivation there for a lot of people that goes beyond just the returns, right? Like, it matters. It does matter in a way for people's kind of like the story that they like to tell, the stories they like to tell, and or the maybe even just what they want to bring to the world. Like, and I think that's powerful. Now, some companies run with that like really far. We don't run that far with it. We understand those motivations. I think they're good for creating demand and getting people excited, but we're serious business, man. Like, yeah, if the deal's not good, if the numbers don't work, like, it's over. And not to like toot our own horn or whatever, but like we have done a very good job with our deals so far. And the fact is, we have to, because we're like, Wyatt and I are coming from this, like, we're a bunch of nobodies in a way, right? Like, you can quote me on that. Like, we don't have like a huge Rolodex of like institutional investors that we've been working with for 20 years, lining up, and we'll just invest in whatever we bring their way, because like we have to earn this trust. And it's earned slowly but surely, and you can lose it like that if you're not careful. But that's why we're careful. And so it feels good. It feels really good to bring great deals to the community, bring great deals to the world. And yeah, if we have stories to tell on top of it, fantastic. Which we definitely do, by the way.
Yeah. Okay, I want to probe this a little bit more, because one of the things that particularly, let's say, appealed to me was this tequila trip. And I'll just take that example. But now, for example, I like volleyball. So when I say, oh, you can major league volleyball, suddenly, wow, this is interesting. But tequila trip, what I see, I think it's a good example because I followed this. I've even quoted it on a podcast, Kaya.
Thank you, by the way. That's, yeah.
No, because it's an example that I get. But, well, you tell me about it, but my understanding is that you can invest in tequila, and just like wine or whiskey, it has potential for appreciation. But also, you go there and you visit, you organize a trip. And I think that's wonderful and fun. And also, perhaps, tasting tequila while signing the contract is the worst possible idea, but I'm sure you do something else. But there's that, right? You don't just, the fact that you've got to bear information if you go there, but I guess that you could skip the trip or something like that, right? And I think it's this whole part of invest. I thought that was interesting because you offer an experience basically, which is quite different from buying.
And the experience isn't just for fun. It's
So it's not the cherry on top. It's really part of the due diligence.
think of it this way: if you want to buy $500,000 worth of tequila in the barrels, like you right now, like what do you do? Where do you go? Tequilabarrels.com. Like there's no market for it. It doesn't work that way. Like the way to do it is to know people, and to know people and really trust people. You have to go down there. And that's what we did. So we've been to Mexico twice now, but our very first trip, the first one I think you're referencing, that was the very first investor due diligence trip we ever did. So we'd been working with our tequila dealer, and yes, he's as cool as he sounds, but we've been working with Miguel for about a year prior to this. And then as we matured as a company and realized like, man, tequila really is a great investment for the reasons that you laid out before. It has all the same appreciation as like wine and whiskey without the weight. Tequila goes from Blanco to Reposado to Anejo to Extra Anejo in 3.5 years, and you're out. That's it. There's essentially no tequila market above 3.5 years. There's some scientific taste reasons for that I won't get into, but the point is 3.5, and that spirit has matured. So back to the barrels for a moment. So cool. We know tequila is a great investment. And now what? We want to buy a lot of this stuff. So we chatted with Miguel for quite a while and said, look, what do you think about us organizing a trip down to Jalisco and to the town of Tequila, where it all started? And that's where you want to be if you're in this world. So that's where Cuervo basically owns the town down there, right? That's where Arete is located. There's a great distillery called Cascoin, which is nearby as well, that we work with. But this is where you want to be. So we took 10 community members along with us, and we turned it into a week-long Mexican due diligence adventure. The focus was tequila, but we also talked about everything from real estate to nearshoring to a lot of other like startup opportunities, a lot of cool things happening with healthcare, and a lot of good stuff happening with finance and mortgages. A lot of private credit, a lot of real opportunity in Mexico. It's an incredibly fast-growing economy, and it's a big economy too. So it's just perfect for alternative investing. But tequila was definitely the focus. And so, yeah, we shook hands. We met the mayor. We saw the barrels. We saw the official like seal of the barrels by the organization that governs what you can call tequila. That matters for due diligence. Like we were there. We filmed that, right? We shook hands, we toasted, and we returned from that trip with a $500,000 investment. That was our very first SPV that we ever put together. And interestingly, that SPV we're about to sell those barrels this year. So we're excited. It's been a long couple of years, but now
so
we're getting.
It's not an excuse to go on a trip to Mexico. It's part of the due diligence. And if it brings you to Mexico. But
it also like it opens up other opportunities. So while we were down there, we met other folks who are doing interesting stuff like outside of tequila that we're thinking about getting involved in. And then we're beyond just barrel investing at this point. So now we're actually investing in a tequila resort. This is going to be an upscale tequila tasting facility with a hotel. This is the long-term vision. The plan is terrific. I love it. So we put an SPV together to fund that vision, bring that to life. So that's actually our third tequila-related SPV. So we're actually well beyond barrels at this point. So yeah, there's a lot.
Sorry. I'll potentially get back to this, but also as we talk about SPV, I think it's important to define what it is and how it works and what are the incentives in terms of fees, etc. there.
So every vehicle we put together is very different. There is no like one size fits all at all. As we're working with companies, as we're working with clients, the discussion starts basically like right away on day one. My first call with clients, I'm already thinking, what can we offer the alts community that they can't get on their own? That is either like access they can't get on their own, or special perks they can't get on their own, right? Like the Mexico trip, but more than that. Or the minimums they couldn't get on their own. Take the volleyball deal we have right now. Like, you want to play ball, like, pun intended, like investing in a pro women's sports team, $250,000 at a minimum. right? So
Yeah.
we can put together a vehicle and you can get in for 10 to 20, right? And it's not guaranteed, and there's a lot that goes into this. I'm going to skip over. But the point is, we're trying to bring people something they access that they couldn't just get on their own. So every vehicle is totally different. Generally speaking, it's like any other alpha seeking or hedge type fund. So typical 2 and 20, that's like a baseline, but it just varies. And then even within the 2 and 20 kind of model, we have a whole system of like our community members where like the more you invest, you earn status within our community. And so like the top folks that have invested like from the beginning, like their fees are a lot lower on every deal. And there's also some other perks and stuff they get. So yeah, it's very customizable, very flexible. Next month, we've got a really interesting vehicle we're putting together. We're working with, I shouldn't say it, but I'll tell you anyway. We're working with a shipwreck company. This company literally is funding asset retrieval from the ocean, copper, silver, other metals. And I definitely can't get into the nitty gritty of the deal.
Sure. It's exciting enough.
But suffice to say, like the average investor, like there's no way like you could get access to that kind of thing without us. And it's funny because the last thing I think you and I we've had a lot of jokes back and forth over the years, and but one of them I think you agree with, like, is that the term like democratization of investing is the most overused like term, because it's not really what it is. It's not, we're not turning this into a voting democracy. Like, we are the GPs for these deals. We and the deal sponsor, we work together. We make the decisions. It's not a democracy. And it's not intended to be one. But what we bring to the community is, again, the trust, the due diligence, which is probably a good segue to talk about how we approach that.
No, indeed. But first of all, before we get into that, I also want to try to understand a little bit more who are those, you call them clients, but investors, right? LPs? Like, can you give us a rough idea?
Yeah, it's not a lot of institution. It's based almost no serious institutional capital. That's the first thing I'll say. So this is not the kind of stuff that
I expected it would be individuals also because of the size, but also the approach. And what I got from what you said is it's clearly community driven, right?
That's it. It's high net worth individuals who are like to invest and think outside the box and like to give themselves an advantage in stuff that they couldn't get on their own. And that's exactly what we're trying to do. And so think of it like there's a lot of folks that work in finance, but they're not investing through their company, right? Like, it's just through their own capital, right? So yeah, aside from finance, it's the usual suspects, a lot of law, a few doctors. We have one of our community members is a maxillofacial surgeon for an NHL team, so he goes to all the games and like if anyone gets really whacked, he works on them. And like, so there's all sorts of interesting folks in the community. Everyone comes from a different walk of life. There's a lot of folks who have made money in real estate, a lot of folks who have made money at a startup.
Okay.
Yeah, usual suspects, but it's not institutional.
Suspect of But also, perhaps in terms of age, well, it's just my guess, but it seems like younger rather than retirees, perhaps?
No, we skew older. We skew way older. We actually just finished doing our annual survey, and I knew we skewed older. I didn't realize just how much. So we have almost no community under 25. Let's just put that out of the way. Which,
yeah, but fair enough, right?
Obviously, they don't have any money yet. That's fine. They will someday.
Yes. Some people, some Mark Zuckerberg here might, but yeah, we give them a bit of time, yes.
But there's actually not a lot of 25 to 35s either. That's what we're learning. It's really 45 and up. There's a large amount of 45 up, 55 plus. Like, yeah. So we skew older for sure.
Which is a classical, I guess, for whatever you call private equity, etc. But I would expect you skew within that realm, you skew a bit younger. But it's nothing surprising there. I would expect it to be older folks like me.
I thought you were like 35, man. What's good?
Thank you. I'm anyway, it's this Riverside filter or something. So, okay, right. We understand the investors, their motivations, their field are pretty clear as well. So let's talk about the due diligence now. As an introduction to that, I want to mention something that you and I have also discussed, at least over Substack on the comments. I just had a chat with a folk, which I guess would fit perhaps exactly that description. Justin Krish is also the guy that's talked to CNBC about it, is Yieldstreet. And it's a guy who works in finance, very clever, that has made some very fortunate investments. He's put some money into real estate, obviously without fully making the appropriate due diligence, but it turns out those were equity deals, so he lost all his money. We're not going to go too much into the details, but I would say it can happen. And I would say as well, just to because I think Yieldstreet, which is now Willowell, is a player that preys on that. I'm very opinionated about it. I think basically the marketing model is so simple that you have the highest possible headline rate deal. So I can offer whatever, 20 or something like that. And I do that by maximizing the risk, taking the most risky bet and hiding this. Obviously there's compliance, etc. There's regulation that I do, but there's a lot you can do within this. I think it's a fair but very summarized description of what they do. And I think that's typically, to me, that's the example of what the risk for people into alts. You can have something that looks super attractive.
Yeah. Just private markets in general. I mean,
yes, with private markets in general. And it's easy to basically, yes, there's a whole lot of small print, but it's easy to be compliant while still hiding the real risk. So having said that, I'm very interested to see in your approach to that and something we discussed, which is the due diligence aspects.
Yeah. Okay. So I'm glad we're talking about this because this is really, I think, what sets us apart. And there's not a lot of companies approaching due diligence in the way that we do. The problem we're trying to solve is that we cannot be experts in all of these asset classes. Like,
I was going to ask about that as well. Yes.
I'm not pretending. I'm not trying to be anything I'm not. Like, there are asset classes that we know better than average, just based on the fact that we've been doing it for 3, 4, 5 years in some cases. Tequila is one of them. But no, we're not trying anything we're not. What we do is we partner like crazy with the experts. So I'm going to give you 2 stories that illustrate this concept of what we call decentralized due diligence. And actually what I'll do is I'll start with how it works and then I'll go into the examples. So the way it works is we tap into community experts, domain experts within the community, I should say, for each deal that we bring to the table. Okay. So the first example I'll give you is a farmland deal. This was I thought interesting deal for growing avocados in the Philippines. Okay. This was a private placement firm that was offering private placements in basically a gigantic avocado plantation in the Philippines. And the numbers looked really good, really interesting. And the story was actually pretty good too. Basically, Asia is developing a taste for avocado, right? There's not a lot of supply. The US can't and doesn't supply enough to Asia. Mexico doesn't really either. There's a huge opportunity to basically start a farmland plantation. And the Philippines they have a lot of natural disasters, but on the west side of the islands, there's stable enough climate, and the climate's good for growing avocados. So there's a company that was basically offering $10,000 investments, and we were intrigued. But I don't know anything about that world, or not enough to bring a deal to the community. So I tapped into our network, and I chatted with a community member. I'll call him T, okay? He's forgotten more about farmland investing than I'll ever know. All right. He's a prolific farmland investor, all sorts of real estate, lives in Argentina, does a ton of on-site visits to different farms all around the world, has a great farmland investing network. He knows his shit. All right. So I had him look at the deal, and he basically came up with a whole due diligence framework for this deal, including a pro forma cash flow analysis, a lot of anecdotal stuff I wouldn't have thought to even ask, let alone answer. And we put this into our report. So we produced this report, and it brought it to like a palatable level. Like, it was good enough to bring to the community, with the caveat that we still hadn't met these guys in person. We hadn't invested any of our own money. Like we were still learning, right? So we put this report out, and T invested his own capital into the deal before we brought it to the community, before we basically made it like an official deal. I said, okay, let me know how it goes. Let's check back in a few months. A few months later, T can't get a hold of the guys. And long story short, there was a rogue employee at this firm that took money, and everyone's looking for him. And
Yeah. The worst case
Whole-
scenario thing.
holy crap, right? The nightmare scenario. So this is actually like a great example of a dodged bullet, right? We did all of our homework, and it still wasn't enough for us to pull the trigger and create a vehicle, but we said, okay, well, at least it gets us to first base. Let's wait it out and see if we can get to second and third. And we never got to second base at all, right? That's the kind of like in this world, you need to be saying no a lot, right? It feels good to say yes, but you have to have every reason to say no. And this was obviously a huge reason to say no. So we didn't do the deal. Now, what did T get out of this effort that he put in? Because you might be asking, well, he lost $10,000 and he did a bunch of homework for you. Okay, well, what he got out of it was he now has the confidence of knowing that when we bring a deal in an area he doesn't know anything about, so he knows everything about farmland, but he doesn't know anything about artwork. He doesn't know anything about Ferraris. He doesn't know anything about K-pop, right? He has the confidence of knowing that there's other people in the community that can put in the same level of effort as him in those areas, so everyone pays it forward. And that's how the system works. This is just one example of, and again, this one wasn't a home run at all. We barely got it off the ground, but by saying no and by proving that, we avoided a lot of trouble and headache for ourselves. So that's the first example. And that's one that didn't work. I'm going to give you an example of one that did work. We talked a little bit earlier about the Mexico trip. That was the first trip we took to really do diligence on the tequila, right? About a year after that, actually not even, it was 9 months after that, we took a trip to Nashville, Tennessee. And the purpose of this trip was to do due diligence on music investing. Music is a funny area, music rights, because the demand is like through the roof in terms of like, just, it's sexy, right? Like people are interested in it. Like it's something that like, you and I talk about this concept of like, it's a story, right? Okay, cool. But what we learned on that trip was, well, it's a tough thing to invest in, like really difficult. First of all, it's just technically tough to understand how royalties work compared to other investable alternatives. But second, it's just, there's no middle class in music, right? You talk about K-shaped economy and like, oh my God, music is the most K-shaped thing imaginable, right?
I can imagine.
So we were down there for a week. We shook all sorts of hands. We made all sorts of friends. And we didn't come back with a deal. Unlike Mexico, we didn't come back with a music rights deal. But we made contacts, a lot of them, and really smart people who understand what we're trying to bring to the world and what we're doing. So 6 months after that trip, we got a K-pop deal come across our desk. And what did I do? I reached out to all of those contacts from the Nashville trip and said, I need your help on this. I need you to do diligence on this deal. I need you to really... And so I got 6 people together to diligence this K-pop deal. And that's the power of decentralized due diligence, right? Like, that's what it's all about. It's just tapping into those domain experts within the community, and we all benefit together. And it's worked very well for us.
Well, that's fascinating. A remark on a couple of questions. The remark first is, it brings me back to Charlie Munger, who was typically the guy saying no in the Warren Buffett deals. What was the nickname? The horrible no man. Yeah, that's it. That was a nickname. And I think that's something super important nowadays. You talk about very esoteric deal, but eventually there's a ton of opportunities. Once you get into it, there's tons of people that will pinch you it. So I think we're at this stage in the investment world where saying no has become the most important skill.
Oh
And the
yeah.
question that goes with that is, still I'm trying to figure out the incentive and how it works because, yes, so is normally that's the best, but in most cases, the right decision. But if you put someone, if you ask someone to help you with a due diligence, if you put a lot of effort into it, if you take a trip, etc., there's also you run a business, right? So there's a sunken cost, maybe bias or something like that. And obviously, you have to have some deals. You have to push through the pipeline. So how do you deal with that aspect of it?
Yeah, it's a great point because after the Nashville trip, I looked at the numbers, man, and between me and you, I wanted to cry. Like we did not make money on that trip because we didn't say yes to a deal, right?
Yeah.
But I had the confidence of knowing that this will pay off in the long run through the connections we make, through the understanding and the knowledge that we've gained. And that's not wishy-washy like hippie like stuff. It's just that's the truth is that like it's a very long cycle for that money to get returned to us, but like it will. Mexico is quick. That was a win for sure. Whereas like the Nashville trip wasn't an immediate win, but we're playing the long game here, man. Like
It's
we're
the
not.
friends you make along the way that count.
That's part of it, but it's also just like
Not friends, useful connections and experts. And all
the
that you can tap
community. It's the
into.
community you make along the way, right? Yeah. Like we are playing a long game here. We are not short cycles, hype cycles. If there's one thing I need to illustrate and try to make sure and everyone listening knows is like we just this is not the company we're trying to build. Now I'm not going to say anything bad about Yieldstreet. I want you to know that. Like I don't know
leave
what
that
it's
to me.
like.
That's why.
Yeah, well, our DMs are another story, but like no, for real. Like look, it's complicated when you have a huge, enormous business with a big fund, and like things can go wrong a lot easier once you let go, once you lose that control. We are not in that. We're not at risk of that. Like Wyatt and I always talk about like so much of what we do doesn't scale, right? And like that's scary because we're venture backed and like we have investors in the community that invest in us, but they understand that like we are I don't want to say slow and steady wins the race, but like we are a steady like wins the race kind of company. We don't take that for granted. Like, and I think that mentality, it works for us. It's the kind of company we want to build. High acumen, high integrity, good amount of singles, a lot of doubles and triples, and yes, we've had some home runs, and we haven't struck out yet. Maybe someday it'll happen, but hopefully by that time we've built up enough positive brand equity that we can weather a storm. Look at Yieldstreet. Like they messed up, man. Okay, like they messed up a couple times, but they also have done a lot well, right? Like so.
Yeah. Listen, I pick on Yieldstreet, and I'm aware that it's a bit too. Yeah, I couldn't talk about it in details. Well, what bothers me is this discrepancy between the marketing or the perception of someone that
Totally
doesn't
fair.
do his due diligence and the risk. But yes, they offer someone to a willing buyer, and fair enough to some point. But yes,
Yeah, I think you make a great point. I'm not trying to. Yeah, I will say that like as we like so we're 13-14 million dollars under management right now. If you gave me $100 million, I wouldn't even know how to deploy it effectively. I literally wouldn't know how to get any sort of advantage, right? Like we are growing our way into the type of management style of business where it's like we feel comfortable now with the level we're at, and then we feel comfortable with one step above that. But I would not know how to effectively deploy even 75 million, let alone like
got it.
above that, right?
There's an aspect of
Someday
yes,
we'll get there, but
sure.
you know,
There's an aspect
I
of
mean, for now,
craftsmanship, but also what I gather, what's really interesting for what we discuss is that the flywheel is the community, right? Because I can see how okay, if you've got more experts that you can tap into different things, and perhaps
yeah.
or a higher level expert, then that's the flywheel. You can potentially, it means like, oh,
Wait.
tomorrow you can tap into something else.
It's not even just the tapping into the experts. That's the back end of the equation. The front end is just the deal flow, right? So for sure, we are in a position now where deal flow is just like coming to us. Like that is an awesome position to be in because I get to say no all the time. No, but for real, because we
Yeah.
don't really have to go looking for it. I actually can't think of the last. There's a couple that we've done the homework, the hard work of getting the deal, but a lot of the stuff is just coming to us now through a friend of a friend, someone from the community, right? Who knows somebody who, oh, you should talk to alts, and it's like that's what we want. That's what we want. And since we know everyone in the community, I shouldn't say we know everybody, but
Yeah.
I feel comfortable saying there are hundreds and hundreds of people whose names like I know to a pretty good degree and I trust and like they're in the club. And so it's like that matters a lot, right? Like in terms of like what we pursue.
And if we look at the downside, and as you said, this, well, hopefully I think eventually it has to happen somehow, sometime, and obviously it's convenient and blah, 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 and you're doing a lot of work to avoid it. But in this diversification, once you get a certain size, certainly there's a lot of things to it. But what I noticed as well, and that's something I read from you, like at some point you were into websites or something like that, and then websites, oh, oops, it doesn't work
That's the
anymore.
micro PE side of things, but
But
we don't really. That's
But
not
my
a
question was not about that specifically, but more about something happened in the tequila market, weather or something like that. How would you deal with something like that? And how would your
so
community deal with it? Knowing that obviously there's risk in everything you do, right?
yeah. The deals that tend to do the best. So actually, all right, let me take a step back. The deals that we pursue and end up creating an SPV for, they have to pass a lot of different criteria. But one of the biggest is there demand for it? And I'm ready to write a check demand. Not like, oh, this looks cool, but like, oh yeah, take my money. Okay. So the next question is, what are the deals that fit that profile? What are the deals that the community wants, right? What are the properties of those deals? Okay, I'd say there's like three things. Like number one, the team or the people behind it have to be like either known or vetted or like that matters. Like the team matters. It can't be just a bunch of randoms that aren't vetted. So if they're a friend of a friend, great. If they're not a friend of a friend, okay, but you need to meet them in person for sure, right? Like that's like a thing. Okay. Number two is the upside. Okay, so in terms of upside, like it's tough to get our community excited for anything under like 12% roughly, right?
Yeah.
I would say like the sweet spot is like 13 to like 18%, really like 14 to 19, that area. Above 22, 23, people just start just getting skeptical.
Mm,
They just get
interesting.
skeptical. They like it sounds like bullshit. Now, there's been deals where I know that it's going to be in the 40s, 50s, right? Like, but I don't even market it. We don't market it that way because it just sounds fucking false. It sounds stupid. It sounds ridiculous, and I don't want to turn people off. I'd rather surprise them to the upside than disappoint them, right? So, yeah, the sweet spot I'd say is like 13 to 19%, that area. And then the number three thing, and this will answer your question, is it's got to have downside protection. Like, so we've tried deals that don't have that good of downside protection, and they just don't do well. So like we did this litigation finance deal about a year and a half ago that I thought was awesome, but and there's a lot of interest in it. But when it came time to put up or shut up and write the check, a lot of community members were like, "I'm out," and the reason is because ultimately it's something that could go to zero. And so like the tequila is not like that, right? Like at the end of the day, like if the weather is bad or there's still a liquid that like worth something. Like that's like not gonna like it doesn't go to zero. And like this is why startups are not a big part of what we do at all. We've tried. I've brought, I thought, some really cool startups to the community. Really interesting companies, Series A, Series B, and then there's a lot of Reg CF stuff on the low end I thought was interesting too. Doesn't matter. Like companies don't, I'm sorry, the community doesn't, it's just too risky. They don't tend to like yield producing stuff for one, and they don't like stuff that can just go belly up. So you'll find that most of the SPVs now, like they're all three of those things, and that sweet spot of the upside, downside protection, and it's like a friend of a friend that kind of brought it to us.
No, that's fascinating because you know what I discovered after this conversation is that it's actually almost the opposite of what one can the caricature of the alts, what we see, or the degen, if you allow me,
Yeah.
or something like that, where
Yeah.
people want to make 2,000% or whatever it was. It's boring and go for it and stuff like that. And also, I think there's something about it which is you mentioned the downside protection, which actually is so important in all those private deals, the covenant structure, right? And again, my view is that if it's an equity deal where there's risk of 0% return, and I think that's what's very confusing for retail investors. Like if you put a retail deal, a real estate deal, and then it's like you're structured in a way that I think those things don't belong in, or there should be a massive warning sign or something like that. And by removing that, you already remove like the big thing, right? The difference between swimming in a CFC where there might be sharks or not, right? And I think that's very interesting. And what I see, the picture that you paint is that there's a lot of subtlety and also things that don't scale, but well, that's what makes it unique.
Well, you nailed it. I would say that like we're getting to the point now where equity is not actually as compelling as lending. I think it's funny, like as alternative investment firms tend to mature, I've noticed this over the past 5 years of kind of studying this stuff. A lot of them just migrate towards lending. Not all of them, but if you think about like the history of alternative investing, like what is it rooted in, right? Like it's basically rooted in private credit and private equity, like for the most part. So that is our kind of that's our MO as well. Like we've surveyed the community, we know what they want. I already named the three things, but the fourth thing, to the degree that there is one, is I think in a given deal, people would prefer a yield producing investment as opposed to an equity. We like to treat equity as a kicker in these deals, but it's 70-30, I would say, like in terms of the mix that we're trying to bring to the community. It's mostly lending at this point. Yeah.
Yeah, no,
But not always. Not always. This volleyball deal isn't lending at all. So if we can make rev share happen, great. But if not, it's not the end of the world.
No, yeah, I understand. Makes also sense with the type of age, etc. that you deal with, and it's a normal thing to do because well, there are equity markets that you can invest in very freely and openly, and so far so good, right? And might not last forever, but I guess that's something that much in the back of people's mind. Stefan, we're running out of time, but this has been a really fascinating conversation. Really eye-opening in terms of what you do. And I think there's a lot in all these things, there's a lot to be scrutinized below the surface. And that's what's really important and also fascinating. I don't know, is there anything else you want to add? And also tell us where we can find you, connect with the alts community.
I'd say, first of all, thanks for having me. It's great to tell our story, and I'd say 2026 is going to be a pretty transformational year for us. Like I'm as you can probably tell, I'm not like a huge like boast about yourself kind of guy or whatever. I hate hype just by default. I like things that are under the radar, under discussed. I don't like overly hyped up things, so I really try to shy away from that when talking about alts, our company alts. But this should be a really good year for us. There's a lot of parts of our equation that are really starting to work. But what's most important is that the community is like just getting really, really strong. And like, man, that word gets thrown around a lot these days. And like, we're not perfect at building community, but because it's freaking tough. But I'm telling you, like, once you get it going, that's a powerful thing. That's a real moat. And so we're excited. I'd say if you want to get involved or just see what we're about, just go to alts.co and just pop in your email and sign up. If you like what you get, you're like welcome aboard. And if not, that's fine too. But yeah, just hope to see you soon.
Wonderful. Stefan, Well, still late in the year, but we wish you the very best for 2026 to you and your family in Australia, and hopefully one day I see you around Victor Harbor, or I know occasionally our paths don't cross, but we can spend holidays.
Awesome. Thanks, George. Appreciate it, man.